This is Taking Stock on Bloomberg. I'm Pimm Fox. Investors, they're all waiting for the next, event, the shoe. Maybe it'll drop. In the fight to purchase, take over NYSE Euronext, the Nasdaq OMX Group could face some antitrust obstacles in its hostile bid to acquire NYSE Euronext. For more, we're joined by the former vice chairman of Nasdaq OMX Group, David Weild, who led the corporate client division where he managed 4,000 companies that were listed on Nasdaq. David is now an advisor at Grant Thornton. David, thanks for being here. Thanks for joining us.
Good to see you, Pat.
All right, so for those that maybe are not so familiar with the way exchanges work, can you explain what is it that NYSE Euronext has that seems to be so valuable to so many players?
Well, first you have to make a distinction between the cash equities business, which is stocks, and the derivatives businesses, which is futures, options, and the like. In the cash equities business, there's three businesses. There's transaction services, which is trade execution. There's information businesses, which is what you actually see on the tape.
Right, the prices that go back and forth.
That's right. And then the final one is the listings business. And in this instance, what you have with Nasdaq-ICE is ICE is contracting in the transaction to take the derivatives businesses in Europe, and Nasdaq is going to take the cash equities business in the United States, which is the core of what we think of as the New York Stock Exchange.
Now, when you say it's the core of what we think of, is that the core of the profits for the company? Because it seems as though the derivatives, the options business, that has been more profitable, at least on a margin basis, compared to the traditional listing of stocks on an exchange.
And you're exactly right. And you raise a terrific point. And if you parse through the bid of Nasdaq and ICE, you'll see that that actually when they split it up, more of the value in terms of aggregate purchase price is going to ICE, and it'll move ICE, if it's consummated, from about the 14th largest derivatives provider in the world to, I think, around number 4.
Now, when you talk about a derivative like an option, the company itself doesn't necessarily have to participate in anything regarding that trading, because that trading is all based on something that underlies it, which is a stock price.
Well, that's exactly right. And I think that one of the concerns about market quality is that it becomes a lot easier for exchanges of all stripes to proliferate what we call synthetic products. And I was down at the International Stock Exchange Executives Emeriti Conference recently, and the point that a lot of these former stock exchange executives from across the globe were making is that there's very little organic growth in the exchange businesses. So what people are doing is they're focusing on proliferating these synthetics. They're focusing on the larger cap stocks, where, say, the top 10% of stocks by size represent about 90% of the volume. And so there's a lot of churning, if you will, that's going around between the derivatives products on the one hand and the underlying common stocks on the other hand. And indeed, that's what stock exchange executives need to focus on, because they're shareholder held, to drive earnings per share. But at the same time, it causes people to pretty much ignore the plight of the small cap issuer, which is interesting because that's the economic foundation of each of our countries. In fact, in the United States, the median equity market value public company is only $450 million, which by institutional terms is a micro cap company.
Yeah, I mean, it's like a rounding error for most big institutional investors. And you've followed this issue having to do with small cap listings and companies trying to access the capital markets. If this deal goes through, whether it's Deutsche Börse buying NYSE Euronext and combining in a 60-40 split, or if it's Nasdaq OMX Group, what happens to those small companies?
Well, because they're effectively a little bit getting orphaned increasingly, because you're focused. This drive to bulk up and make stock exchanges bigger, to be able to take costs out of the equation, to drive earnings per share. That mission is not compatible really with focusing on small companies. I would fire the CEO of any one of these major exchanges if they were focusing too much time and attention on the small companies, because that's not where the earnings per share growth is. If you look at the transaction with the way it's been positioned with Nasdaq and ICE, they're talking about taking $700 million in cost out of the equation, because think about it, we have these major technology plants between Nasdaq and New York in the United States, and those two plants effectively can be rationalized, and so they can strip a lot of cost out of the equation and, in theory, increase earnings per share by running a more efficient plant.
All right. Now, I know you're not a regulator, but I mean, do you have any inkling as to which way you think the regulators are going to go here?
Well, you know, it's kind of imponderable. On the one hand, that this merger it really appeals to your patriotic, sense itself, if you will. I mean, it's nice to see it kept in the home for the United States. Although I would say that, that with a publicly held stock exchange, you can have shareholders anywhere in the globe, and so it's not necessarily clear that even if you have the two merged in the United States, if the shareholders are all going to be American, there'll be likely a lot of Europeans and even Asian shareholders in it as well. So I think that the bigger concern is, do issuers have choice? The listed markets is really a monopoly. If you look at, will become a monopoly of sorts, and the way the market structure trades, there's very little difference, if you will, already between Nasdaq and the New York Stock Exchange.
David Weild, Grant Thornton advisor, thank you very much. Keep us up to date on this topic. Appreciate it.